Fundstrat's co-founder and head of research. Welcome back. It's good to see you. It's been a while.
Yeah, great. Great to see you, Scott.
Now, I'm going to start calling you Prescient Tom. I hope you don't mind, because this morning at 10:23 in the morning, you said possibly this is the flush. Bottom line, possibility equities reverse into the close. Well, it looks like you called it, Tom. What do you think about this reversal and what it means?
Well, I think if we think about the data for the past week, the stagflation story that gained a lot of prominence in the last 10 weeks, I think has diminished a lot because the jobs report showed good jobs, but soft on wages. We're making progress on the UAW strike. And then, of course, as you know, oil's come off that boil. And these are all pointing to an expansion that's not suffering from an acceleration of inflation. So I think it really helps the idea that, as you said, maybe the flush happened and we can be strong into year end.
Do you really think that this is that moment that that turn is going to begin to happen, Tom?
Part of the tactical view comes from Mark Newton, but I think it was going to be either today or early next week because we had that intraday reading of the put call reach 1.97 only 20 times the last 30 years. It's so rare, but it has almost always signaled an imminent bottom. And then today, as you point out, we had a really hot jobs number, a pretty big sell-off that is reversing in the face of people still saying nothing's gotten better. So I do think the sellers are exhausted and there's a lot of firepower on the sidelines. And if a few things go right, I think we get a big rally.
I know, but the one thing that's not really getting better, and I don't want to ignore it, rates are still high, right? So we were at 488 earlier today on the 10-year, so we're at 477. So we've come off, as you said, the boil, but we've still got a pot that's really simmering rapidly.
That's right. I mean, these are very tight financial conditions. It's probably not a long-term killer if we were at 5 for years, because we know 5% is the average for the 10-year for the last 90 years. But at the moment, that change has been very restrictive. If I was to be half full on this, we know this also means the Fed has less work to do, which means fewer hikes. So in some ways, as long as the market can absorb this change, and it's very restrictive, I mean, it's uncomfortable, I think that's positive. More importantly, as Walter Deemer pointed out, when you have a parabolic rise in rates, it's not going to take the escalator back down. If it does peak, it's going to be a sharp reversal. And of course, that's supportive for stocks.
Yeah. You think the Fed's done? Do you think Mary Daly was a pretty big tell yesterday in thinking that San Francisco Fed president, of course, thinking that the move that we've seen in interest rates has caused financial conditions to tighten substantially, in her mind, equal to at least one hike in rates, and that now that is the prevailing thought within the room, that credit conditions have tightened enough, we're restrictive, as you said, we're done?
Yes, I think the Fed feels that they, since September 20th, I think it was clear the market kind of got this new message, well, higher for longer. The market's priced it in. I don't know if the Fed has to keep jawboning it and even threaten further hikes if it's gotten to the place it wants to be. And as you're saying, when you have a Fed member saying it's a hike, another hike on top of that means that we're extra worried.
How about valuations? Are you comfortable where they are and where, just simply relative to rates being high? And, you still believe the economy to some degree is going to slow. It's just hanging in so incredibly resilient. It's stunning. I don't know what else to say.
Yes, I mean, I know intuitively investors think PE has to come down because interest rates have gone up. But history shows when the 10-year is between 3.5% and 5.5%, the PE is averaged close to 20 times. Part of it is something that Sheila Bair had written about. It produces capital discipline, and that allows companies to have durable earnings, which means PE should be higher. But also, we're in an environment where nominal growth is higher, which means I also think we're in an EPS surprise environment. That's why PE should go up. It's really 16 times, actually less than that, ex-FANG. I think if it goes up four turns, that's a huge upside in equities.
Okay, I'm glad you went to earnings because I wanted to get there anyway. So you don't think that estimates which have crept up incrementally positive this quarter, a little bit more next, and then more substantially, obviously, as we get into 2024. You don't think those are, over their skis a little bit?
I mean, earnings always have some risk because of optimism of analysts. So 70% of the time, earnings revisions are down. But the revisions to Q3 earnings are more consistent with a turn in the cycle. And we have to remember the headline earnings are still down year over year because of energy and basic materials. Without those, it's close to 7% earnings growth in third quarter. I mean, that's a really nice, companies are doing well. I think the greedflation is going to hurt. And of course, we have some volatility with the strike. But I think the overall picture is demand is holding up. And now wage costs are slowing. That should help be supportive of earnings, actually.
Yeah, I mean, you said, ex-FANG. So let's drill down on that a little bit more. What are we talking? 15 times for ex-FANG? Basically, the 490 whatever stocks within the S&P 500 versus the mega caps. So if you think we're going to hang in there, and from an economic standpoint, and you think the Fed is done, and you think rates are not going to really, go much higher from here, do I want to start looking at ex-FANG, or do I want to just dance with the stocks that got me here to begin with?
Scott, I don't want to sound like I'm saying both, but when I think about how re-risk, like when institutions want to add risk in fourth quarter, they're going to buy what's liquid and what's worked. So I think that's why FANG should lead. But the reason the rest of the rest of the S&P is attractive is that you have a level set of 7% earnings yield, or maybe 6%, but with earnings growth double digits. The total return profile of equities here trounces what you can earn on a 10-year. And I don't think investors are convinced of that today, but a year from now they will be. And that's why the S&P could have more than double-digit gains over the next 12 months.
I know, but you make a good argument, though, even as you argue for stocks relative to bonds. Others would say, look how cheap bonds have gotten as rates have gone up. So there's still considerable competition in a really uncertain environment, whether it's cash equivalents or treasuries themselves that still offer a safer, let's just use that word, safer alternative.
Yes. I mean, I think it's correct for people to have that view. How many additional make that decision in the next 12 months, I think, is what matters. We already have seen trillions flee out of risk assets. The stock market has been starved of retail and institutional equity flows. The movements have all been just prime brokerage leverage. Buybacks will continue. I think on the margin, if inflation is diminishing next year and people think the Fed is done or might cut, that's good because bonds could rally. But as we know, I mean, if that happens, we know PE is going to go up a lot, so stocks will rally even more.
Let's bring in CNBC contributor Bryn Talkington of Requisite Capital. Tom, she's going to join the conversation. So, Bryn, I believe you heard everything that Tom had to say. Do you agree?
Well, I think that going back to like the technicals, let's go back there. I think that we started the week with only about 15 stocks above their 50-day moving average. When it gets below 20%, that's really bullish from a short-term bottom. That was right on top of the S&P, almost getting to 4,200. So I think we were in this really oversold conditions. And I think, great job on Tom calling for a midday rally. And so I think we can definitely rally from here. Don't forget Monday, the bond market's closed. So this party can continue because there's nothing to stop it, because really this has been a rate-driven market. So I think that's going to help. I do think, though, over the next few months, outside of seasonality, which is a real thing, right? I would never discount it. I think over the next 6 months, though, we're going to be much more range bound between this, let's say 4,200 to like 45, 4,600, because I still think there are so many cross currents. I think on the earnings front, though, if you look at Goldman Sachs, I think Costin does good research. Technology is where you're going to get all of the earnings growth next year. So they're looking for 10% earnings growth, year over year from 23 to 24. And so we're going to have to get that because those stocks are more rich. And so I am not in the consensus that I think we're going to have this 12% earnings growth. And so when I break down the names, I do think you still want to own technology. But within technology, I think you have to be, somewhat judicious, because while, if you look right now, Scott, Microsoft and Apple's charts look terrible. Their revenue and earnings growth haven't been as good as, let's say, at Google and Microsoft. I mean, a Google and Meta, whose charts look really strong and continue to gain momentum. So it'll be interesting to see if we start getting some dispersion of those mega cap names, especially as earnings come out next quarter. We'll see, but I think that's a pretty decent probability. Some dispersion of the mega caps starts to play out.
I feel like, Tom, that's a long way of saying that, you know, Bryn, I'm not necessarily as optimistic as you are, Tom, that earnings are going to reach the level that some, like Goldman and others, suggest that they might. Now, they might in mega caps. That jury's still out, but certainly not elsewhere. So, Tom, how do you respond to that?
Well, I mean, I think there is a pretty long list of worries out there. Because, you know, if I were to add to Britain's concerns, I would add China and Europe and the war and the escalation of the Ukraine war. But in this environment, which has been incredibly challenging for companies, they're able to produce 7% earnings growth now in the face of the Fed relentlessly raising rates. But in the next 12 months, they're taking their foot off that. Oil, I think, might have made a local top. Wage pressures went from, you know, nearly 6% on their way to 3.5%. And a 10-year environment like this with nominal GDP does point to very good earnings growth historically, and the PMIs have convincingly bottomed. You know, the ISM was stuck below 46 for several months, now back to 49. So to me, it's pointing to an economic momentum that's materially improving. So I think that rate of change is what's going to compel stocks to get PE expansion.
Tom, what do you make of, you know, weakness that we've seen in utilities and staples and transports and things like that? Are they any bit attractive? I know that all of these other sectors, you know, the lights on the marquee, they're the ones that are there. I get it. But sometimes you see the best opportunities where the greatest amount of carnage lies within the market. Utilities, staples, things like that. Are they attractive to you or not?
Yeah, utilities. Look, for someone who's really great with timing, utilities, risk-adjusted, probably are huge opportunities. I mean, I bet you it's going to follow TLT, right? TLT at some point is going to make a pretty tremendous upside move if Mark Newton's right, and you know the 10-year goes back towards 4% next year. And on transports, it's tricky because you've got to pay attention to what's happening there, but there are a lot of interplay dynamics that are idiosyncratic and not necessarily simple macro. And then staples, I mean, it's tough because, you know, that's a greedflation sector, and now it's on the margin some strange stories about, you know, calorie consumption could be declining. I mean, it's tough. I think I'd rather own technology stocks over staples because at least technology stocks you don't have to worry about calories.
Yeah, I mean, I don't know that you'd find too many people fighting you on the idea of owning technology stocks over staples. So I don't know if that's necessarily a fair fight. But Bryn, how would you address those two sectors, or just simply other areas of the market that might work outside of big tech?
So I think going back to utilities and staples, you know, we were looking. If you look at the net debt to equity of every sector in the S&P, which three sectors have the highest debt to equity ratios? Utilities, real estate, and staples. And so I think that those three areas, and so we're talking about two of them, are just much more susceptible to the D of the D and the E, right, to rate rises. So I think this is a unique time, typically later stage in the economic cycle, those would be doing well. We have a whole new playbook. I think that people can count on large cap technology to know what you're going to get. You might not get great revenue growth, but you're going to get good earnings because they're all buying back their shares. I think from an allocation perspective, what my concerns are is that I agree with Tom that the economy is probably going to stay really strong, but for the wrong reasons, because it's government-led. Because don't forget, we had the 1.9 trillion American Rescue Act, and then three other ones underneath them. Those dollars, Scott, need to be spent. There's billions and billions of dollars that need to be spent by 2025. And so you're going to continue to see municipalities doing very, very large infrastructure plans. And so bottom line, what does that mean? That's good for the economy, but what else is that? It's inflationary. And so I just think we're in times where the government is spending like they're trying to get out of a recession, and they're doing this pre-recession. And to me, that ends up causing just a higher probability that recession stays stickier because of government-induced programs into the U.S. And so to me, that puts somewhat of a ceiling on rates as well as markets, because we're going to continue to be having this inflationary conversation. We're not getting to 2% anytime soon.
Well, we seem to be on the march there. Tom, I think you'd probably disagree.
Yes. I mean, to the extent that I don't think it's a fait accompli that inflation is going to be accelerating or sticky. I mean, as we know, the only sticky part of core inflation right now is shelter, and housing is going to get walloped as mortgage rates stay here at 8. So to an extent, this rise in rates is accomplishing what the Fed wants to do, which is kind of put a ceiling on home prices for now. And that's going to really restrict CPI. I mean, 40% of core CPI is basically housing related anyways. Autos, that makes it close to 57%. So as long as cars and housing aren't accelerating, inflation is on a glide path lower.
Tom, what's your target for the end of the year for the S&P? You still have one, correct?
Yes. Scott, I think we're going to rally double digits. So I think we're going to get over 4,800 by year end. I mean, a lot has to go right. And I'll tell you, there's a lot of damage in the last few weeks, so it may not get to 48, but I think directionally is correct that I think we have a very strong reflexive recovery because interest rates are nearing an end of a parabolic rise.
Wow. Well, we'll see for sure, and we'll talk to you plenty of times about it. I appreciate it, everybody. Thank you. Bryn, we'll talk to you soon. And Tom Lee, of course, Fundstrat. Let's get to our question of the day.